Welcome back, everybody. Thanks for joining me once again. For those of you new here, this is your friend Nate, and as promised, I'm going to give you guys a crash course in how I go about valuing public companies, right? So like we talked about in the previous video, if you want to go into a new, more advanced realm besides diversification and rebalancing, if you choose to become an individual appraiser of public stocks, this is more so about how that approach really works. And so I'm going to be referencing Phil Town's books. Like I said, he's got Rule 1, he's got Payback Time, he's got Invested, he's got those 3 books. And then you have one by Mary Buffett. The book is called Interpreting Financial Statements. And so based on those books, I put them together in my approach along with a few other books as I continue to enhance my own process and how I value publicly traded companies on my own. And so the first step Phil Town teaches is all about meaning and understanding the company. All right, so this has to be a company you're familiar with. You understand how they make money. You understand their history. You've read some annual reports on their company, some 10Ks, right? Some quarterly reports, the 10Qs. And overall, you've familiarized yourself with this company, and it's something you're on board with. All right. The next step, it's called moat, also known as a durable competitive advantage. We want to find out if this company is a fantastic company. And so a few things are going to stand out. So we're going to check their return on invested capital. We're going to check out their equity per share growth rate, their earnings per share growth rate, sales growth, cash flow growth. And just to take a little turn here, we're going to also add from Mary Buffett's book, Interpreting Financial Statements, we're going to take a look at the income statement. First 2 things we're going to check out, we're looking for consistent margins. And so for gross margins, we're looking for 40% roughly consistently. And we're looking at 20% net margins consistently. The next thing we want to do is we want to take a look at the balance sheet. We're looking for low debt, which would be 4 times free cash flow or less. And the next thing we're going to look at is the current free cash flow multiple, right? So we're going to look at the cash flow statement. We're going to take cash flow from operations and subtract out the purchase of property, plant, and equipment, and that's going to give us a close enough relative cash flow number, and that's what we're going to base our multiple on. And the next part is going to be management. So for that, one thing I like to do is I like to look at their return on equity again. I also like to look at their return on assets, which we like to be around 15%. Also, again, we want to double check that debt. Make sure there's low debt. If you have high return on equity with low debt, high returns on assets, like I said, around 15%, that basically insinuates that you have good, solid management running this company. And the last part is the margin of safety, right? So where on the spectrum does this company fall? We talked about in an earlier video, there's 3 ways to value a company, right? The assets, current cash flows, and then current cash flows plus an anticipated growth rate. We don't want to pay more than 20 times the current free cash flows regardless of growth estimates. And the next question is, are you receiving at least 15% a year long term if you were to purchase at a certain price? And also, we talked about growth rates earlier. One key ratio to keep an eye on, right, is going to be the PE ratio, the price to earnings ratio. If you divide that number in half, it indicates the current consensus is that earnings will grow at that rate. So, for example, if you have a company that's selling at 20 times earnings, right, a PE of 20, that means you're paying 20 years worth of current earnings to invest in that company today. One of the reasons why people will pay 20, 30, 40 PE ratio, right, 30, 40 times earnings is that they anticipate it's obviously going to grow, right? And so just to keep in mind, when you're looking at a stock and you see the PE ratio is 20, 30, or 40 or higher, the consensus based on the current price is that it's going to grow at roughly half that rate. So if you see a PE of 40, you have to ask yourself, especially if there's a lot of excitement around the company, do you really believe with the current consensus that it's going to grow at 20% a year into the foreseeable future? And that goes back to the speculation part like we talked about earlier. So you want to be conservative in your estimations there. And once you find a price that you would be willing to pay for the company, ideally where you're going to make at least 15% per year, you're going to have that buy price. And what you want to do, I see a lot of people make this mistake. They want to put all their money into one investment at one time, but what they forget is how volatile the stock market is. You'll buy a company and then it'll keep going lower and lower and lower, and you're going to end up wishing you had more cash on the side to dollar cost average lower, raising your long-term returns. I don't know if you guys have ever heard this, but you really want to buy a stock hoping that the price goes lower than what you purchased it at, right? Because if you do your analysis and the current return is 15%, which you wouldn't want to get less than that if you're taking the time to appraise public companies yourself. Ideally, you would purchase a company and it would go significantly lower than what you purchased it at, because you would be lowering your risk and raising your returns at the same time long term. And so the strategy for that is to divide up what you believe the company is worth per share. Just divide it into 4 or 5. And so that way, you know what your entry level price is, right? You put a quarter in or a fifth in, and then as it keeps going down and hits those other targets, then you can purchase again. You want to really avoid putting all of your money in at one entry price, because then you won't be able to take advantage of lower prices. All right, guys, so we talked about, just to summarize here, we talked about Phil Town's 4 M's, right? Meaning, moat, management, margin of safety. And definitely a key focus here is that moat, that durable competitive advantage. You'd be very surprised how many companies cannot maintain high margins, gross margins, and net margins. And the reason for that is because of the law of diminishing returns, right? You guys saw this in so many different industries, but especially in the cannabis industry, right? So you saw that new industry was there, significantly higher margins. Anyone that was able to retool equipment and farm cannabis, they entered the market and brought those margins down. And so you'll see this. People get excited about new industries, right? It's the new this, it's the new that. This is going to change everything. Well, that draws a lot of attention, which causes the law of diminishing returns. And so you have to keep that in mind anytime you see, your friends talk about a stock pick or this pharmaceutical company or this cannabis company or this crypto speculative business that's going on. Keep all those things in mind, right? High margins don't last because of the laws of competition and diminishing returns. So just keep those things in mind. Investing shouldn't really be an overly exciting operation. You're just looking at, how can I make a reasonable return per year? Am I putting my money in a safe place? Am I getting reasonable returns for low risk, reasonable risk? And that's basically the thought process here. It shouldn't be trying to get rich overnight. It's very easy to get wealthy slowly, just on this same process. Don't try to, gamble your savings away. Just be strategic about it. Take your time, save your money, and then continue to develop your financial philosophy and your investment education. And these opportunities will start sticking out to you more and more as time goes on. Anyway, once again, thank you guys so much for joining me. I hope you guys learned something new and valuable, and can't wait to make another video for you soon. Thank you.